Understanding indicators can transform your trading, but only if you truly know how they work behind the scenes. In this video, part of our series, The Best Trading Indicators Explained, Step by Step, we're breaking down one of the most important tools used by traders around the world. No hype, no guessing, just logic, structure, and real examples. Today's focus? The simple moving average, one of the simplest but most widely used indicators in technical analysis. Let's get started. Let's start by adding a simple moving average to the chart. On TradingView, click on Indicators, then type Moving Average Simple in the search bar. You'll see several results including scripts created by the community and custom indicators. Make sure to select the one listed under the Technicals category. That's the official built-in version from TradingView. By default, it applies a 9-period moving average to the closing price. Once the line is visible on the chart, hover over the indicator name at the top left corner and click the gear icon. This opens the settings panel where you can fully customize how the indicator behaves and how it looks. Now let's go over the full settings of the simple moving average, starting with the Inputs tab. At the top, we have Length. This controls how many candles are used to calculate the moving average. The default is 9, but for this example, we'll set it to 10. Next is Source, which tells the indicator which part of the candle to use. The default is Close, meaning the closing price of each candle is used in the calculation. But you can change it to Open, High, Low, or combined values like HL2 or HLC3. Then we have Offset, which shifts the entire line forward or backward on the chart. This doesn't affect the calculation. It's only a visual adjustment. A positive number moves the line to the right. A negative one shifts it to the left. Below that, you'll see the smoothing section. By default, the type is set to None, which means no extra smoothing is applied. But if you want to smooth the SMA itself, you can select another moving average type, like EMA or WMA. Once you do, the length field becomes active and lets you set how many periods the smoothing should use. The BB standard deviation field is used in Bollinger Band calculations and isn't relevant here. Under Calculation, the time frame setting controls which chart interval the SMA will follow. Set to Chart, it matches the current chart time frame, like 5 minutes, 1 hour, or daily. The checkbox below, Wait for time frame closes, ensures that the SMA is only updated after each candle fully closes, giving you a more stable and reliable reading. If you uncheck it, the SMA updates live as the candle is still forming. Lastly, under Input Values, the option Inputs and Status line controls whether the SMA's value and settings appear at the top left corner of your chart. It's useful to keep this enabled for quick reference. Now let's switch to the Style tab. Here, you can customize how the moving average line looks on the chart. The MA checkbox at the top lets you show or hide the line. If you turn it off, the indicator still runs in the background, but nothing is drawn. Next, you can change the color, line style, and thickness. This helps you make the SMA more visible, especially when working with multiple indicators. Under Output Values, the precision setting determines how many decimal places are shown. You can leave it on default, which automatically adjusts based on the instrument you're viewing. Then, you have two display options. Labels on price scale shows the current SMA value as a small tag on the right side of the chart, aligned with the line. Values in Status line shows the current value and input parameters in the top left corner of the screen. Finally, we have the Visibility tab. This tab controls which time frames the SMA will appear on. You'll see options for ticks, seconds, minutes, hours, days, weeks, and months. Each row lets you set the visibility range, for example, from 1 to 59 minutes or from 1 to 24 hours. If a box is checked, the SMA will be visible when that time frame is active. If it's unchecked, the indicator will be hidden in that range. At the bottom, there's also a Ranges option, which allows for more advanced visibility control, but in most cases, you won't need to use it. With all these settings adjusted, your SMA is now fully configured and customized. In the next step, we'll look at how the moving average actually works by breaking down the full calculation in detail. Now that we've covered the default settings of the simple moving average, let's take things one step further. To help you truly understand how the SMA works, we've developed a custom indicator that breaks down the full calculation, right on the chart. It's designed to mirror the behavior of the standard 10-period SMA, but with one key difference. It shows exactly how the average is built, step by step. On the left side of the screen, we have a breakdown of the last 10 price values used in the calculation. These are labeled from P0, which refers to the most recent candle, the one currently forming, all the way back to P9, which represents the candle from 9 bars ago. Because P0 is still in progress, its value is constantly updating until the candle closes. And that's exactly why we sometimes see the tip of the moving average line shifting slightly in real time. The average is being influenced by a price that hasn't finalized yet. This brings us to the core of the simple moving average. In step 1, all 10 values from P0 to P9 are added together. That gives us the total sum of the selected period. In step 2, we divide that total by 10, since this is a 10-period moving average. Finally, in step 3, we get the result of that division, and that's the number being plotted on the chart. What you're seeing is a real-time representation of the average price over the last 10 candles. The SMA smooths out individual price movements, helping you visualize the general direction of the market. Because it updates with every new candle, dropping the oldest value and including the newest, it continuously reflects the market's most recent behavior. And that brings us to something we'll repeat in every video of this series, because truly understanding this one principle can change the way you trade. If you've already heard this message and it resonates with you, feel free to skip ahead. But we strongly encourage you to stick around and even replay it until you can repeat it by heart. This isn't just theory. It's the foundation of consistent, sustainable trading. Here's something every trader needs to hear, especially if you're just starting out. Indicators are not magical signals. They don't predict the future. They simply reflect what's already happened. They're tools, valuable ones, but still just tools. They help you read context, not control outcomes. The real problem begins when traders expect certainty, when they treat indicators as if they guarantee success. That mindset leads to frustration, disappointment, and an endless cycle of jumping from one strategy to another. To really understand why this happens and how to avoid it, here's a powerful reminder from Mark Douglas, one of the most respected voices in trading psychology.
You're trading on a smaller time frame and you get a little pullback right here, okay? And based on that pullback, your methodology says, okay, it's time to buy. And you do, just before this hedge fund manager comes in and starts driving the price up. See, you're going to think that the reason why you won is because that your mathematical formula told you what was happening next. And that was the reason why it happened. What I'm saying to you now is that there almost isn't any reason that you could come up with, whether you won or lost, that would correspond to what really happened in the market, other than the fact that there was an imbalance in conviction between buyers and sellers. And the reason, the people who report it in the news agencies, they don't know either. They're making it up. They make up the reasons because they sound reasonable. They are paid to sound reasonable. And there's no way to verify what it is that they say. You see, we'll put on a trade and find ourselves in a nice monster little winner here and think, oh man, my methodology, it is just fantastic. And then the next time you get the same signal and then you don't get anything. Not only that, it's a loser. You think, oh, now you feel betrayed. You think your methodology let you down. Your methodology wasn't designed to tell you what's going to happen next on a trade-by-trade basis. No technical methodology is. That's where your expectations are not in line with the reality of the situation. That's why it's so easy to make mistakes. It's because you're expecting something from your methodology that just doesn't exist. It just doesn't. It never did. Technical methodologies don't tell you what's going to happen next on a trade-by-trade basis. They will tell you what will happen over a series of trades on a percentage basis. This particular pattern will emerge X number of times, and when it does, there's a higher probability of this happening than that.
And just in case you're still holding on to the illusion of control, here's another story he shared. And it says everything you need to know about how unpredictable the market truly is.
There was a guy that came to me for consultations. He was a guy that lost a lot of people's money. He was basically what he was. He was an excellent analyst. In fact, as far as market analysis was concerned, he was probably one of the best analysts I'd ever worked with. But the problem is that as far as executing his trades, let's put it this way, he was, let's say, on the arrogant side. So he came to me for consultations, and basically after listening to him, I said, hey, you know what? Why don't you do something, get paid for something that you're good at, and and stop trying to stop losing other people's money, and go get a job as an analyst. And so he did. He got a job with one of the major clearing firms at the Chicago Board of Trade as one of their analysts for their brokers and that sort of thing. And the chairman of the board, he was an old-time grain trader, soybean trader, and made his money in the 40s and the 50s and that sort of thing, and traded pit-style trading. He didn't make direction-related trades. And so he was really mystified with the idea of technical analysis. I mean, he really was. He was literally mystified with the idea that you could basically predict prices based on chart patterns and that sort of thing. So he thought, well, you know what, I'm going to sit down with this guy and, you know, this star analyst here that we have in the firm now and find out what this crap is all about, basically, is the way he thought about it. So he's sitting down with him for a few days, and it got to a point where one day the soybean market was basically, you know, trading in a range, about the middle of a range between what the analysts projected as the high of the day. Not just the high of the day and the low of the day, okay? And so the market drifted around, you know, like, maybe did a little bit of close to a test of the high, coming down to the low, and they're both sitting there and they're both watching it right now. And the chairman of the board says, okay, so this is going to be the low of the day right here, right? The guy said, yep, that's it. Gets that price, it's the low of the day. Low of the day. And the guy looked at him and he said, that's bull. And he picked up the phone, which had a direct line to the soybean pit. He said, sell 10 million beans at the market. Now, 10 million beans is 2,000 contracts because they trade in 5,000 bushel increments. So he hit the market at that moment with 2,000 sell orders, okay, which immediately drove the price down 10 cents on 2,000 contracts. And then after the price dropped, he looked at him and said, hey, if I can do that, anybody can do that. Now think about the implications of what I just said. Oh, gee, what if you were one of the people that bought right here? How many people did it take to mess up your trade? Just one. Just one person. That's all. It's usually more than one, but that's all it takes is one. You guys starting to get the idea? This kind of stuff is going on all of the time.
So the next time you find yourself waiting for that perfect signal, remember this. It only takes one player with enough size or conviction to completely invalidate your setup. That's why mindset matters. That's why context matters. And that's why indicators, no matter how popular, are tools, not crystal balls. And that wraps up our breakdown of this indicator. In every episode of this series, we'll keep reinforcing the same core message. Indicators don't give you an edge, how you use them does. To help you move from theory to practice, check the card above and the description below. We've linked real strategies that use this indicator in action. And if you want to keep growing, take a look at our full training programs. We've got smart money concepts to help you understand how the big players move the market. Technical analysis for day traders, focused on fast practical decision making. The Wyckoff method to help you read price and volume with structure. And most importantly, our complete trading psychology playlist, because no matter what strategy you use, mindset is what makes it work. Take the time to study. Focus on building real skill, not chasing shortcuts. Because at the end of the day, it's not the indicator that makes you profitable. It's how well you understand and use it. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube.